moving averages are vastly misunderstood, and I'm constantly seeing people using them the wrong way and not even understanding what they are and what they're meant to do. So in today's video, I'm going to be breaking down exactly what moving averages are and how to properly use them to become better traders and investors. So let's just jump right into it, guys. Today, we're covering moving averages. We're going to be talking about the difference between an EMA, exponential moving average, and a SMA, smooth moving average. And we're going to be talking about how these help us with trend, momentum, support, and resistance. So first, moving averages. The moving averages filters the noise. So as we know, on a daily basis, now you can change the different time frames to daily, weekly, monthly, hourly, 1 minute time frames. That gets really, really crazy, obviously. We know that moving around the time frames and the price action especially can get very hectic and wild with candles, haiku candles, line charts, whatever you want to use, right? It can get very hectic on a daily basis. We're going to be sticking to the daily time frame today and get very noisy on a daily basis. And what a moving average is supposed to do is it's supposed to take all that noise and bottle it up into a simple line that shows you the overall direction of the stock, because moving averages should really be used to understand the direction of stock price overall and the momentum behind a stock price. Okay, so that's first and foremost. So price obviously is very fast, it's noisy, it's emotional, but averages smooth, slower, and useful context to show us the overall trend. As you can see in this chart right here, this is price action, the white line, and the blue line is that consistent smooth moving average, showing you a smooth average over time. Next up, we're going to be talking about specifically the smooth moving average. The smooth moving average takes all candles across the board and calculates them equally. So it's not just closer time frame is weighted heavier than 50 days ago, right? It's consistent. Over 50 days, every single weight of a candle every single day has a consistent weighting on that smooth moving average. That's really the difference in a smooth moving average. So it's slower to react, it's smoother trend and less short-term noise. Now, an EMA, an exponential moving average, doesn't consistently go 50 days of consistency. It goes, okay, well, 30 to 40 days ago of the 50 days is looked at lesser than the recent 10 days. So each day and each price movement within that day has different weighting. So the closer you are to present time, it has more weighting with EMA, exponential moving average, than farther away, like 50 days ago out of 50-day look back, than that has, right? So that's the key difference. Smooth moving average is going to take equal across all 50 days. EMA is going to take lesser on farther away days, right? So 50, 40, 30 days ago compared to the last 10, 20, 30 days, right? It's going to take more weighting into more present time. Okay, now that we got that over the way. So you see same period, different reaction speeds. This is exactly why you have SMAs and EMAs. We can now use our code talk because you guys understand what they are. Now we understand why SMAs and EMAs look different, even though they can both be set to look back 50 days exactly. It's because a smooth moving average is looking across 50 days equally. An EMA, an exponential moving average, is looking across 50 days unequally. Next up, let's talk about different look back times, right? So each moving average answers a different question. Now, what is 9, 10, 20, 50, 200? You've all heard these before. You've heard about the 200 week, or you've heard about the 200 moving average. You've heard about the 9 EMA. You've heard about the 21 EMA. You've heard about the 50 moving average. You've heard all of these, but what do they actually mean, and what is the number behind it? Well, the number behind it is simply just, this is how far you're looking back. So if you want to look back 9 days, you're looking back at the last 9 trading days. If it's 21, you're looking back at the last 21 trading days. If you're looking back 50 days, you're looking back at the last 50 trading days. And 200, you're looking back at the last 200 days. Now, depending on which one you use, right, as we just learned, if it's a smooth moving average, 200 days back is exactly 200 days, equally weighted across the board. If it's 200 days back on the moving average for exponential, EMA, then it's going to be less weighted towards 200 days ago, 100 days ago, and more weighted towards 20, 50, and 70 days ago, right? So it gives more weight to the closer period of time. Which again is why you get differences in these EMAs. Now, you have a 9 EMA, which I'm going to focus on today. This is really is momentum strong right now? What is going on in the last 9 days? This obviously brings us down to basically the last 2 weeks of trading days, as you really got 5 trading days in a week typically if you don't have a holiday. What is the last 2 weeks really showing us in the momentum of this stock and this stock price? Okay, 20 or 21 EMA. This is more short-term trend. Is it intact? 50 EMA or SMA. This is where you typically get into SMAs once you get higher. EMAs are typically used for 9, 21, 13. And then as you get above 50, people are usually using smooth moving averages. Okay. So what is the intermediate trend? Is over 50 days, as we talked about. It's equally weighted. What is the trend line showing us? What is the 50 SMA showing us? Then we have our 200 SMA. This is what is the long-term trend? What is the actual long-term trend here? Are we going up like this in a slow locomotive, or are we going down like this in a slow locomotive, right? 200 trading days is a long period of time, so it's not going to move crazy in a short period of time. It's going to show you this is where we're going over a long period of time. Next up, let's talk about the 4 ways moving averages can improve its setup, and then we'll actually get into the charts, show you how to set these up in TradingView, and then talk about some examples. 4 ways moving averages can improve a setup. 1 is trend. So is it above the trend or below? Is it above the moving average or is it below? If the stock price is above the trend, then that is a uptrend, and that is bullish. And if the price is below the trend, then that is bearish. Okay. Is it rising or falling? Are we staying above the moving averages and are we rising? That's obviously very bullish. Obviously, if we're staying below the trend and falling, then that is very bearish. You can also use these for support and resistance. Typically, especially for the larger ones like 50 SMA or 200 SMA, typically you're going to get decent bounces off of these moving averages. You're going to get a support, which supports the stock price. When it hits, it bounces off, or resistance. As it comes up to that price, it bounces and rejects off of it. So you get a lot of support resistance around this. Pullback entries. If you're trading these names or you want a good entry, want a good area to dollar cost average into an investment, then you're going to use these averages to basically, when the stock price comes back to them, you understand that this is a better risk reward because it's coming back into its overall trend, and typically it should bounce off of its overall trend if that trend is going to stay intact. Obviously, these shorter dated times, 9, 13, 21, are going to support less than like a 50, 100, or 200 SMA moving average, okay? And then crossovers. So when you get a 9 EMA crossing through a 21 EMA to the upside, that's going to be bullish. When you get a 9 EMA crossing to the downside, that's going to be short-term bearish. When you get a 50 smooth moving average crossing through a 200 moving average, that's going to be bullish. When you get to the upside, that's going to be bullish. When you get it crossing a 50 SMA crossing down through the 200 SMA, that's going to be bearish. So these are 4 different ways to help you understand moving averages and improve your setups. The line is not the context. It is not the trade. So you cannot just like sit there and say, oh, this line is here, so as soon as it hits it, every single time we're going to bounce off it. That's not how this works. That's not how life works. We know that there are no certainties, right? So you cannot buy every touch. You cannot trade every crossover. You cannot ignore the price structure, obviously, and using too many averages can get very bogged down. Today, for a very simplistic reason, we're going to focus on just 3 simple lines. We're going to focus on the 20 EMA, we're going to focus on the 50 SMA, and we're going to focus on the 200 SMA. So these are going to be your short-term, medium-term, and then long-term actual trends. And so we're going to jump right over into Google chart, and we're going to talk about 2 scenarios on Google where we had a nice clean uptrend and a nice clean downtrend. Okay. Simple. This was 2025. And in 2025, we had tariff get-in. We had this consolidation, right? And so first, sorry. Green is going to be our 20 EMA. Blue is going to be our 50 SMA. And then red is going to be our 200 SMA. And we are on a daily chart. How do we get these on our charts? You simply go here to TradingView, indicators. You type in EMA. And then you set moving average exponential. You click that. And then you click SMA. And that's going to be simple moving average. You click that. And then essentially all you're going to do, you're going to go into this. You're going to change whatever color you want. Input 9. Obviously for today, we're going to be doing 20. That's how you change the input. We don't need that anymore. That's how you set it up. For SMA, this is how you do it. You put in SMA and then you're simply going to change the color again here. And you're going to change this to, again, for today, we're going to do 50. And that's it. And you'll do one for 21 or a 200 as well. So you'll have a 20 EMA. That's going to be blue. You have a 50 SMA. That's going to be green. You'll have a 200 SMA. And that's going to be red. Now we can get into breaking this down. So again, your 20 is always going to be leading. Your 50 is going to be next in line. It's second fastest. And then your 200 is slowest. Look at this 200. Look how it barely moves over time. This is obviously an uptrend. This is consolidation, chop sideways. And then this is an uptrend again, right? Uptrend, consolidation sideways, uptrend. You see that? It literally goes down a little bit or kind of sideways. And then it goes in these clean uptrends. But it moves a lot slower than, say, your 20 or your 50. Your 20 really can go up and down but keep holding price higher, then it can really start dropping. And same with the 50, it can really start dropping. But while that's happening, the 200 is just kind of, going a little sideways, a little dip, and then it comes back up and goes up. As most stocks go up and to the right over time. As we know, the stock market goes up and to the right over time. So some ways to read this, right? So obviously on this little uptrend here, every time we came back into the 20 EMA, what happened? We got right around it and we bounced higher. Almost every single time over, over 2 months, right? But what can happen when you start testing the EMA in quick succession over a shorter period of time, say like a month or so, this starts weakening your support, right? Because all these times it hit here, that's support. It's supporting price and sending it higher. But eventually it breaks below the EMA, as we saw here. And once it breaks below the EMA, things got very bad very quickly. And I'm guessing this was probably around in earnings. And then you got a crossover, which was bearish. And then you had the 50 moving average flowing down as well. And you went from 207 down to about 140. It was a pretty decent sized sell-off. But what I want you to see is first a downtrend. A downtrend, you're going to cut down and you'll keep coming back towards the 20 EMA, but you'll keep bouncing or rejecting off of it. If that keeps happening, you're in a clear downtrend until, as you can see right there, right? Clear downtrend. The price is below the 20 moving average or the 20 EMA, and it's consistently rejecting off the 21 EMA, telling you that, nope, we are still bearish. But you will get these flips eventually where it starts leveling out. The 20 EMA starts leveling out. The 50 EMA starts going sideways. And then you see price consolidate and then start moving higher. And then with that consolidation, you'll start seeing price start going above the moving averages and start using them as support, as we saw here. And then obviously you'll get eventually a bullish cross 20 going through the 50, right? And as that happens, you'll start flipping. So you're starting to use the 50 and the 20 as support. So you flipped above the 20 and the 50 at the same time. You first supported on the 20 right here, and then you supported on the 50. and then you continuously started supporting on the 20 EMA, and that told you, hey, this is a clear uptrend. We're consistently making higher highs, consistently moving up, and every time we come back to the 20 EMA, we were sitting there bouncing off of it. And if we were to break through the 20 EMA, right, like we did here, we get around the 50 EMA, and that's going to be support for us. So as you can see, right, this was a clear downtrend. We're staying below the moving averages, and typically as a downtrend happens, you're typically going to stay below the closest downtrend or closest EMA. So 20 EMA, you're going to consistently stay below that and continue to reject off that. Once you start breaking above that, then you might start having some things on your side. And then as of right here, we started an uptrend, and the moving averages are lagging indicators. So they're not going to show you that we're going to start a new uptrend. Price has to do it itself, and then the moving averages follow, because these again are lagging indicators. And then obviously, like we see right here, we can see that we did move into from a downtrend to consolidation into a clear uptrend until recently, where again, we went below the 20, we went below the 50, we had a bearish crossover, we came back, retested the 20 EMA, rejected off that once, twice, multiple times, until we finally came down here closer to the 200 moving average, kind of bounced up away from that, moved up above the 20, moved up above the 50, then had a bullish cross up, and then continued higher. Again, these are lagging indicators. These are not some magical thing that's going to say, hey, we're going to go into a massive, or they're not something that's going to sit there and say, hey, this is bottom, this is bottom, this is bottom. They're more so going to just show you, if you get into this investment down here and these continue to hold, the 20, the 50 continue to hold, this is just telling you, hey, you're good. Continue to hold your trade, continue to hold your investment, because this is in a clear uptrend until you get a bearish cross, until you get this downtrend. And that's where you just kind of know, hey, this is where I'm going to just exit my trade. If we go below the 20 or the 50 EMA, I'm going to exit my trade right here. So that'd be a very solid trade, going from somewhere down here, 174, all the way up to 320. And then you exit your trade and you made all these gains. That's really great. If it's an investment, you could use it more so, hey, I'm going to buy around the 200-day moving average. When we get around to the 200-day moving average, I think that's a great time to be buying, because the average is in an uptrend, obviously, as we see here. And if we get down around there, it's a good buying opportunity, as we saw here, 271 up to 410, or 315 up to about 384. These are good times to be buying if you're a long-term investor. So you kind of see how these EMAs and SMAs can really help you see the overall trend. They can show you, they could be support in an uptrend, they could be resistance in a downtrend. They can show you where the momentum lies and what the overall trend and momentum is doing in any given stock or indexes or whatever, right? So this is why these are so important to have. I don't think you need to have a 9, a 13, a 21 EMA, a 50 EMA, a 50 SMA, a 100 SMA, a 75 SMA. You don't need to riddle your chart with all of these moving averages. And you shouldn't put all of this weight into them as if this line is going to just magically say, yep, right here, we are not going to go through this. As you know, if that's the one time, here's the thing. If you bet on all these times down here that we are going to bounce off these EMAs and SMAs, then you would have been right 1, 2, 3, 4, 5 times. And then you eventually would have been wrong. And then that's where you would have lost on the trade, right? So this is why these can be really lucrative, because if you're betting 1, 2, 3, 4, 5 times and you're going 5 wins and 1 loss, that is really good. And that's giving you an upper hand as a trader. So the best time to be buying into your trades should be around these EMAs, because more than likely, if you're in an uptrend, these are going to hold, and these odds say that, this is the best time to be buying. This is the best time to be getting in these as trades. And then as an investor, guys, again, just buying close around the 200-day moving average. If the stock is crap, the stock is crap. It doesn't matter if you buy it above, below, inside, outside the 200-day moving average. If the stock is crap, the fundamentals are getting worse, then the stock is crap, the fundamentals are getting worse, the stock price is going to get worse. If you pick a good stock and the fundamentals are getting better and you buy around the 200-day moving average or 200-week moving average, then you should do very, very well. Just like Google, right? Google, you're buying around the 200-week moving average 1, 2, 3 separate times in 2025 and 2026. And each time we've been significantly higher. Microsoft, if you've been buying, obviously this is another really good example, right? So you have 2025, you were in a downtrend, right? And then you were in an uptrend, and then you were in a very fierce downtrend, but now you're breaking up and out of that downtrend. Now you're going into this new uptrend, right? You see that. And with this new uptrend, right? Okay, 20 crossed above the 50, but then it crossed back down below the 50. You want 20 above the 50, you want the 20 EMA above the 50 and above the 200. Then you want the 50 to get above the 200. And then you'll be up and away because the 20 EMA is leading. The 50 SMA is right there behind it, showing increase like this, 20 EMA, 50 SMA. And then here's the slow moving 200 SMA, right? That's what you want in a clear uptrend. And so, something like Microsoft, it got really far away from its 200 moving average. This is also why I say dollar cost averaging is your friend. Consistently buying in a stock over biweekly or monthly, over months, and building out your position is the best way possible because, it just makes you not say, Microsoft's is super cheap right here, I'm going to go all in. And then you have to suffer all of this. And you're not bringing your cost basis. You're not buying here, 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 and here. You are buying only here. This is your cost basis. Instead, let me draw this. This is your cost basis. Instead of you kept buying on the way down evenly or buying more when you got lower, then your cost basis would actually, instead of being here, it would be about here. And now you'd be up instead of being barely up. You'd be up a lot instead of being barely up. So that's moving averages. I hope you guys got value out of this video. I didn't ask it the whole time. Please give me a like, give me a follow, give me a subscribe if you guys enjoyed this content. If you want to see more tutorials like this, I appreciate your time. I hope you got value out of this, and I'll catch you guys in the next one. Leave a comment down below on what other tutorials you guys want to see from me. Thanks, guys. See ya.